Good evening, ladies and gentlemen. Sorry for the slightly delayed start. That's for a variety of reasons. In the city of Bangalore, there is a thunderstorm, and we had some problems with the technology. So, like meticulous planning, we have invoked a plan B, which therefore makes sure that other than this 10 minutes delay, we would be spot on with the webinar. Before we begin, I'd like to introduce the other members of the team. You'd be familiar about their face, but you'll actually see them in person now. Can I invite Divya Parikh and Ranjita to come up so that the participants can see them in real life? So far I've been seeing only their photographs. Yeah, come on up. That's Divya Parikh. And this is Ranjita Shastri. They've been doing a lot of the back-end work to make sure these courses fly the way they do. And I'd also like to introduce you to Yusuf. Can you just come over for a minute, Yusuf? Yeah. He and his colleague Navneet, who unfortunately couldn't join us today, they're the people behind the camera and make me look better than I am in real life, so that you don't get fed up of my face when you watch those videos. So that's Yusuf for you. Okay, so now I'm solo on the screen, and let's begin. We've had a lot of interesting questions. Now, some of them did have an overlap. So what I've basically tried to do is sequence them in a way that there will be some continuity to this webinar. I'm going to take them in three parts. The first part is where, looking at the answers that you give to a lot of the quiz questions, etc., and there's a lot of analytics available on the edX platform. So we were able to see a pattern in some of the errors. I'll go through those. Then the second part, there were some lack of clarity on the concepts, so I'll go through that, and then take the questions in large measure, particularly in terms of capital adequacy, statutory liquidity, and so on and so forth. Okay, so the first one, if you recall, one of the first things we learned in this course was the Fisher equation, which is the relationship between nominal interest rates and expected inflation. Now, if you recall from that video, we had an abridged version of that equation and an unabridged version of that equation. In fact, one of the quiz questions, the graded quiz, was using the unabridged Fisher equation, answer the following question. Now, most of you have used the abridged Fisher equation. So let me clarify that for you. We have a problem here. Using the unabridged Fisher equation, determine the nominal interest rate if expected inflation is 4% and real interest rate is 2%. Now, if you use the abridged equation, which is nominal interest rate equal to real interest rate plus expected inflation, you would get an answer which is 2% real interest rate, 4% inflation, and therefore the nominal interest rate is 6%. But if you use the unabridged Fisher equation, which is 1 plus nominal interest rate is equal to 1 plus real interest rate into 1 plus expected inflation. So now the formula would be 1 plus 0.02 into 1 plus 0.04, and this 1 from the left side of the equation will come to the right, and therefore the nominal interest rate computed using the unabridged equation is 6.08. So there is a difference of 0.08%. In the real world of finance, we always use the unabridged Fisher equation, which is 1 plus nominal interest rate is equal to 1 plus real interest rate into 1 plus expected inflation. But just for ease of understanding, if you expand that, you will get the term IR into EI, which is 0.02 into 0.04 in this example, which is a 0.08, which we tend to ignore, purely because it's much easier for you to understand the relationship between real interest rate, expected inflation, nominal interest rate, if we took the abridged version. But I repeat, in the real world, it is always the unabridged equation that we should resort to. There's another issue that I think a lot of you got flummoxed. Supply side financing is originated in any economy by which entities in a country. Now, there are three entities, if you recall the three entities involved who contribute to the financial system. The demand side, that means consumption demand, like you and I. We want a home mortgage, we want to buy an automobile, so we take a loan from a bank, etc. So we trigger the demand side financing. Now, if all of us want to buy automobiles and homes, then there is demand for cement and steel and everything else to build houses, more furniture, more white goods, and therefore companies that are involved in the manufacture of those items would want to expand capacity, so they would want to finance their investments. They are the supply side of the economy. You and I as consumers are the demand side of the economy. So supply side financing for a financial intermediary is lending to companies that fulfill the supply side. Mortgage loans, automobile loans fulfill the demand side. So supply side financing is what businesses and government contribute to. Government because they have to build infrastructure, new power plants and so on and so forth. Businesses because they need to produce more cars, more cement, more of everything. Okay? So that's a supply side financing. From a financial intermediary's point of view, these entities trigger supply side financing. I hope that clarifies that question. The next one is net worth of a bank. Net worth, as you know, is equity plus reserves or retained earnings. Net worth of the bank is currency units 200 million. The board of directors of the bank has decreed that loan losses. Oh, before I do that, if any of you have any questions or clarifications, do post them on the little box on the right side of your screen. It will be picked up by Divya and Ranjita, and they will pass it on to me, and I'll be able to respond to your questions in real time. Okay? So let's get back to this. Net worth of a bank is 200 million currency units. The board of directors of the bank has decreed that loan losses attributable to any particular industry sector for that bank should not exceed 20% of the bank's net worth. That is 20% of 200 million. That is the maximum loan losses that this institution can take. So 20% of 200 million is 40 million currency units. Now, if the expected losses in the steel sector, that means companies in the iron and steel industry that this bank is lending to, if the expected losses in the steel sector due to loan defaults, steel companies not repaying their loan, is 10%. So you got two numbers here, 20% of the net worth and default rate is 10%. The question is, what is the maximum loan amount the bank can provide to the steel sector given these numbers? Now, I was a bit surprised that several of you, either you didn't understand the question or you got the numbers mixed up. Remember, we have a very powerful analytics tool which will help us analyze every answer that you've given in every quiz. So you can't get away. If you got an error, we know how to spot it. We know who has made the mistake. And don't be surprised if we send some emails to some of you saying, hey, you got this wrong for this reason. So this is one of those questions where several of you got it mixed up somewhere. The answer is the maximum loan loss possible is 200 million, which is the net worth of this institution. 20%, this is a board decree. The board of directors have said no single sector we can afford to lose more than 20% of the net worth, which is 40 million, 20% of 200 million. The loan default percentage is 10%. So given that number, if we were to calculate what's the maximum loan that this bank can give to entities in the steel sector, the number is 400 million. Because 400 million, 10% of that, that's the maximum default, is 40 million. 40 million is 20% of the bank's net worth, which is 200 million. So the way it works is, there's somebody sitting in the credit risk management group. So every new proposal for a steel company comes up, they're going to see, is it exceeding our total exposure for this sector, which in this case is 400 million. Okay? So up to 400 million, this institution can lend cumulatively across all steel companies to whom they have lent. If it exceeds 400, the credit risk department would decline it. This is a great way to ensure there is no concentration risk in any particular sector. Now, what we could sense from all the questions that came and the way you've answered the quiz questions, that there is still a serious lack of clarity on cash reserves, statutory liquidity reserves, capital adequacy, etc. So I'm going to spend the next few minutes clarifying those concepts in our own minds, and then we will address a lot of very interesting questions that some of you have raised in this space. Capital adequacy, cash reserve, statutory liquidity reserve, and so on and so forth. Now, cash reserve and statutory liquidity reserve, if you will recall the videos on that subject, CRR, cash reserve ratio, and statutory liquidity ratio address the liquidity requirements. Now, what do we mean by that? In common parlance, liquidity is the equivalent of a cash crunch, In other words, if there are depositors who suddenly come to the bank and want to withdraw money, those who are giving the liability support want to withdraw that support, the bank should have adequate cash to be able to meet that outflow. Most central banks and monetary authorities around the world therefore prescribe a minimum of cash that must be kept. Cash need not be physical cash in the vault. It could also be money that is kept as a credit balance with the monetary authority in that country. So it's like your checking account, you want to withdraw money, you write a check and take the money, or you use the ATM to take the money out. A bank does exactly the same way in its account with the monetary authority in that country. So if there's an excess withdrawal of deposits, it just draws the money from its account with the central bank or the monetary authority. Now, the monetary authority, anticipating these kind of exigencies, normally prescribe a minimum percentage of the deposits, customer deposits, because that's what could cause the liquidity problem. So they ask banks to keep 4% of your deposits, and we've used the word net demand and time liabilities. Now loosely I'm using the word deposits, but we will understand the meaning of that phrase NDTL, or restate our understanding of NDTL in just a couple of minutes from now. So cash reserve to overcome liquidity problems. Now, in some countries there is a level 2 which is called the statutory liquidity reserve. Now, this is nothing but, in the cash reserve it's kept as physical cash or balances with the central bank. In the case of statutory liquidity reserve, you invest some part of the deposits that you've raised in liquid instruments such as government securities. And what do we mean by liquid instruments? If the bank needs to convert it to cash, it can easily sell it in the debt market and be able to convert it to cash so that it can meet its cash outflow obligations. Not all countries have the statutory liquidity reserve, but virtually every country in the world would have a cash reserve mandated by the monetary authority of that country. In fact, if you go back to your videos, I have given the example of two countries, United States and India. The India context is far more constricting as far as the banks are concerned, because there's a 20% statutory liquidity ratio. So if you're a bank and you have a deposit base of 100 million, 20 million of that will have to be invested in government securities. 4 million of that will have to be kept as cash. The United States does not have the statutory liquidity ratio, which is the 20%. It only has the equivalent of a cash reserve. I'm not able to recall the percentage, but it's somewhere close to 4%. That is liquidity. Now, what is solvency? Solvency is a matter of survival. Solvency usually arises either because the loans that the bank has given, there is a huge default. That means borrowers are not repaying. Now, this is a problem triggered on the asset side of the balance sheet. Liquidity is a problem that is triggered on the liability side of the balance sheet, and you keep cash to be able to sustain that. Solvency, on the other hand, means either the loans are defaulting or the corporate bonds that the bank has invested in is gone kaput. It's become junk bonds, which means it is sitting on a mark-to-market loss on the bonds, or it is sitting on loans which are not being repaid. Now, this could happen no matter what precautions you take in the banking and financial intermediation business. Loans will always default, investments could go wrong, and therefore you need a cushion to protect yourself against losses arising from these scenarios. Now, solvency deals with that, and capital adequacy is the measure we use to ensure that the bank is solvent even if things go wrong in terms of its asset portfolio, loans and investments. We will see an example of that just to reiterate our understanding in just a couple of minutes from now. So I hope you understand the difference between liquidity and solvency. In the real world, solvency comes first. I'm sure in the countries you come from, you would have heard of, there was a run on the bank. Now the run on the bank is a liquidity problem because depositors are queuing up in front of the bank to say, I want to fold up my deposit and take the money away. Now, why did that liquidity problem arise? Because fundamentally, the bank's loans were going bad. The bank's stability was at stake. It had a solvency problem, and it did not have enough capital to protect itself against that solvency problem. So usually, an underlying solvency problem results in a liquidity problem. In fact, the 2008 crisis, and one of you had raised this question about the 2008 crisis. If all these protections were there, how did the 2008 crisis happen? The 2008 crisis was primarily a simmering solvency problem. Nobody saw it until one fine morning it just panned out as a liquidity problem. We will see that in just a few minutes from now. So the calculation of CRR and SLR, which is to manage the liquidity, is done through what are called net demand and time liabilities, which is money that is owed by the bank to the depositors or to other banks. That's the net demand and time liabilities. Demand liabilities is your checking account, your current account, and so on, from which you can withdraw money anytime. As a customer of a bank, almost every one of us would have a checking account or savings account, as it is called in some countries, or a current account, which is what most businesses would have. Time liabilities are certificate of deposits, fixed deposits, as it's called in some countries, and so on. They are time driven. You keep the money with the bank for a certain period in time. Demand deposits, you can withdraw any time. That's the difference between the two. Now, all of these are customers' money kept with the bank. Now, net interbank liabilities. Banks borrow and lend to each other. So if I'm a bank and today I have surplus money, I would lend to other banks. That's reflected on the asset side of the balance sheet. But if I'm short of money, I would borrow from other banks. That is demand liabilities. That is interbank borrowing. One is interbank lending, the other is interbank borrowing. Now, what matters when you're computing the net demand and time liabilities is the sum of, algebraic sum of whatever you borrowed from other banks minus what you have lent to the other banks. The logic is, if you have lent to another bank and you are in a liquidity crunch, you will just tell those banks, we want our money back. So that's not included in the calculation. It's only the net figure that is included in the calculation. Now let's go to capital adequacy, and in the end, after these 2 or 3 slides, we will revisit a problem that will help you understand all of these concepts in greater detail. Capital adequacy is how much capital have you got, equity, reserves, and other long-term liabilities, to support the deterioration in the quality of your loans and repair to your investments in bonds and securities. Tier 1 capital very simply, is money living in the balance sheet of the bank that actually belongs to the equity shareholders of the bank. So that would be equity capital, and several types of retained earnings or reserves. So in most countries the terminology is different. You have capital reserves, statutory reserves, and there are some voluntary reserves that you can create. Now what can be included in Tier 1 capital is equity capital, equity stocks into the book value of the stocks, number of stocks issued into the book value of the stock, number 1, plus the statutory reserves, which is virtually all of what we call the retained earnings. Remember, both of these belong to the shareholders. That is Tier 1 capital. Tier 2 capital is other long-term liabilities, which could be borrowings by the bank for 5 years, maturity 5 years or more. These are called subordinated debt or Tier 2 bonds. So banks issue Tier 2 bonds to sustain their capital. So Tier 2 capital is long-term liabilities other than what belongs to the shareholders. Long-term liabilities, it does not include customer deposits. All right? You can't use customer deposits to resolve a solvency problem. You can only use your Tier 1 capital and your Tier 2 capital. I'll reiterate this when we go and look at a problem in just a few minutes from now. Assets, earning assets, loans and investments. Those are the earning assets. Now, those are the crucial elements. If they come under pressure, they lose value either because bond prices have fallen or because loans are not being repaid. That's when you have a solvency problem. That's when you use your Tier 1 and Tier 2 capital to ensure stability of the bank. The arithmetic of that we'll just see in a minute. And risk weights, which I believe would be clear to most of you. If I have given a loan and I have a collateral for that loan, I'm a bank, I've given a loan to you and you've given me a collateral. That loan is less risky than another loan that I may have given where there is no collateral, or a bond that I have subscribed to. And bonds are intrinsically unsecured instruments. There is no collateral. So the ones that are collateralized carry less risk, and the ones that are not carry more risk. If you have lent to a AAA rated company, it intrinsically carries less risk. If you have lent to a CCC company, it will carry a far higher level of risk. That is the risk weight. So if you have invested 100 crores in government securities, the risk weight is 0. There is no risk at all. On the other hand, if you have lent 100 crores to a BBB rated company, there is a risk. There is a chance that only 20% of the money will come back, 80% could be lost. The risk weight is 80%. Because out of the 100 million that you have lent, 80 million might not come back. That's your asset at risk. The risk weighted asset is 80 million. The earning asset is 100 million. So we only use risk weighted assets when we are computing capital adequacy. Tier 1 capital, as I said already, is equity, retained earnings, which is mandatory by law, and any losses that are carried forward which has to be subtracted. If you think about it, profits in a year add to the retained earnings. Losses made by the firm in a year will actually reduce the retained earnings. So if in some countries losses are not allowed to be deducted from the retained earnings, they are kept as accumulated losses on the asset side of the balance sheet. They just hold it. For our calculation, we would take the reserves minus the accumulated losses, which is the third bullet point there, carry forward losses. Carry forward losses means last year I made losses, it's sitting on the asset side as carry forward losses, 50 million currency units. This year again I made losses of 75 million currency units. My carry forward losses this year, at the end of this year, would be 125 million currency units. And if my net worth, equity plus retained earnings, is 450 million, for the tier 1 capital will be 450 million minus the 125 million, which is the carry forward losses. So that's how you calculate tier 1. Now there are nuances to this, several other minor computations. It varies from country to country because that is at the discretion of the monetary authority in that country. So I'm not going to go into that. Virtually every central bank or monetary authority in the world would have a website where they would have put out their rules for computing capital adequacy, etc., as a PDF file. So you should be able to download that and take a look at it. For example, the Federal Reserve has it. I know for a fact that the Reserve Bank of Australia have it, the Reserve Bank of India have it, Bank of England have it. I've looked at 4 or 5 of these central banks, all of them have it. And they would give complete details of how tier 1 capital is to be computed, tier 2 capital is to be computed, how risk weighted assets are to be computed. So it's actually a spreadsheet. You just follow that PDF file which they have put out, apply the rules, take your balance sheet, apply the rules, and you can calculate your capital adequacy. So the finer computations vary from country to country. It will be impossible for us to go into this level of detail because remember, a course like this has a hugely heterogeneous audience. We have participants from almost 150 countries. Now we can't be going into each one of those. So you could go into your respective country's central bank website and find the finer details in that website. Tier 2 capital, sorry, I stand corrected, I should change the heading. This is tier 2 capital. The previous one was tier 1 capital. This is tier 2. There's a mistake in my heading, I'll correct that. It comprises of 2 things essentially: subordinated debt and provision for loan losses. Now subordinated debt is long-term debt raised not from customers and depositors but from other entities. It could be some institutional investors, it could be other banks. Now these are bonds issued by banks. The minimum duration for that is 5 years, a little over 5 years, and it must be issued at a premium over the yield on 5-year government securities in that country. So it's not as, the longevity is not as much as equity and retained earnings, but the longevity here is 5 years for tier 2 bonds or subordinated debt as they are called. And every year when the bank makes a profit, there is a computation that is done to say how much of my loans are potentially bad loans. That means not likely to repay. So a certain percentage of that is taken out of the profits and kept in the balance sheet as provision for loan losses. Now this is like putting money away for the rainy day, so that on the day the loan becomes bad actually and repayment stop, we don't have to scurry around and say it should be subtracted from our current year profits. It will be culled out of the provisions that we have already made. All right, so that's provision for losses. These are the 2 main items in the tier 2 capital. Now let's go through the summarized balance sheet of a bank in the next slide to compute the tier 1 capital, the tier 2 capital, the risk weighted assets that should be considered to estimate the capital adequacy of a bank. I'm not doing an example for computing cash reserve and statutory liquidity reserve. I'd urge you to go and look at the corresponding videos in the course. Capital adequacy seems the one that has challenged more of you, and therefore we'll just go through a quick example. Now take a look at this. This is a summarized balance sheet of a bank. You have on the asset side investments in government bonds and municipal bonds, investment in corporate bonds, unsecured commercial loans, mortgage loans, fixed assets, cash. Those are on the asset side of the balance sheet. And on the liability side you have equity capital, retained earnings, provision for bad loans, subordinated debt, customer deposits. And the regulator has told you that the risk weight for each of these kind of items is investment in treasury and municipal bonds 5% because they are government instruments issued by the government, so intrinsically lower risk weight. Investment in corporate bonds 100% risk weight. Investment in loans, unsecured, 100% risk weight. Mortgage loans, because it is backed by a house which is a collateral. You take a mortgage loan to buy yourself a home. So the home is the collateral. You have mortgaged it to the bank. So the risk weight on that is lower at 60%. Fixed assets, there's no risk in it. You can always sell the fixed asset, so it's presumed to be 0%. And cash, well, cash is no risk. So that's 0% too. Now, I didn't dream up these numbers. These numbers would be made available to every bank by the central bank or the monetary authority in that country. Now, total assets 3,800, total liabilities 3,800, and contingent liabilities. Now, contingent liabilities are unlike a loan where the cash has been given out to the borrower by the bank, or an investment in government securities where the bank has paid the money to buy those securities. Money has gone out of the bank. Cash has gone out and it is showing as loans or investments. Contingent liabilities, on the other hand, there is no cash outflow involved now, but it could potentially be a cash outflow for the bank. For example, when a bank issues a letter of credit, only if the importer for whom they have issued the letter of credit defaults on his payment, that is when the bank is hurt. That's why it's called a contingent, right? Or an off-balance sheet risk. And what we are saying is, for this institution, the total outstanding letters of credit is 1,000 currency units, or 1 billion currency units. The risk weight is 100%, and the conversion factor is 50%. Now, what this means is, there's only a 50% chance that if a letter of credit payment is not made on the due date, that it will become a bad loan. But if it becomes a bad loan, you lose 100% of the money. So the maximum loss that you would suffer is 1,000 into 50 into 100%. So the maximum loss you would have is only 500, not 1,000. The same would apply for all of these. In fact, every derivative contract, those of you who are familiar with derivative contracts, every derivative contract that a bank writes, every letter of credit that a bank issues, every guarantee that a bank issues, all of these are contingent liabilities, because the cash flow might or might not happen at a future date. Unlike a loan or an investment where cash outflow happens today and you acquire the loan as an asset or you acquire the securities as an asset on your balance sheet. So the risk associated with contingent liabilities is lower. However, they must be included in your risk weight assets calculation. So I've not got the formula here. The risk weight, the capital adequacy calculation is Tier 1 capital plus Tier 2 capital divided by the risk weighted assets. So if you go back, if there are two banks, one bank has invested all of the money in government securities. Another bank which has invested all of that money in corporate bonds and loans. Obviously, the denominator for the second bank will be much larger than the first bank, which means to arrive at the same capital adequacy ratio, it needs to have twice the capital. So T1 has to be higher, T2 has to be higher. And those of you who are familiar with finance, capital is the most expensive item to obtain. The cost of capital in most countries around the world is upwards of 10%, and cost of debt would also be equally high. So whether you're taking it as Tier 1 or Tier 2, your cost is going to be much higher, which means a bank which is lending to more risky customers needs to keep more capital, and if it needs to keep more capital, it's costing it a lot more, and therefore it's going to hurt its profitability. Now, there's a very interesting question one of you had raised. If all these protections are there, why is there a financial crisis? Why did 2008 happen if all these protections are there? That's a very interesting question, and I'll come to that in a few minutes from now. What we are now talking about are the mechanisms available overseen by the banking regulator in the country to make sure that the financial system is in a state of adequate stability. What causes it to become unstable, as it happened in 2008? There are several causes, and all these good measures could go out of the window if the banks and the other financial market entities start to take on a huge amount of risk. So if you put it in simple terms, your capital T1 plus T2 remains constant, your denominator has gone through the roof, it's kind of doubled, therefore your capital adequacy is halved, and therefore you need to bring in more capital. If you don't, your bank is unstable. That's the way it works. So now remember, what we need when we look at capital adequacy ratio calculations is, on the asset side we need investments in treasury and corporate bonds, commercial loans, mortgage loans, etc. No cash is included in that calculation, no fixed asset included in that calculation, because both have risk weight of 0. And what you need on the liability side is equity, capital and retained earnings, and provision for bad loans and subordinated debt. All that goes into your capital adequacy calculation. Now what goes into your cash reserve calculation are the remaining items. It is cash on the asset side of the balance sheet, and it is customer deposits, or NDTL as we saw, on the liability side. So the two are mutually exclusive. Remember, I'm going back to what I said in the beginning. Cash flow crunch is a liquidity problem. So who is going to demand cash to be withdrawn suddenly? It is the customer, it is the other banks who have lent to you, and you need enough cash to be able to sustain that cash outflow. So cash reserve is cash divided by net demand and time liabilities. It does not include any of the other line items in the balance sheet which goes into the capital adequacy calculation. For capital adequacy, in this example, equity plus retained earnings is tier 1, provisions for bad loans and subordinated debt is tier 2 capital, divided by risk weighting all of these items, the first 4 lines here, that's the risk weight. So I hope you understand the mutual exclusivity of cash reserve ratios and capital adequacy ratio. Cash reserve to manage liquidity, capital adequacy to manage solvency. Right. Now with that background, let's take some of the questions. During the lecture in section 6.1, we have learned that tier 1 capital consists of paid up capital. This is a question posted by one of the participants. We have learned that tier 1 capital consists of paid up capital, statutory reserves and capital reserves. That's exactly what I said. Carry forward losses should be deducted from that summation result. Correct. That's what we just discussed. For simplifying it, can we calculate tier 1 capital as combination of paid up capital and retained earnings? That's incomplete. Paid up capital is this. Retained earnings is statutory reserves and capital reserves. The carry forward losses, if it has already been subtracted from the retained earnings. Remember what I said before. If a bank makes a profit in the year, it adds to the retained earnings on the liability side of the balance sheet. But if the accounting rules in that country says profits, and if it makes losses, it must be subtracted from the retained earnings. That's the logic. Profit positive, add to retained earnings. Profit negative, subtract from retained earnings. But some countries don't allow you to do the latter. They say if you make a profit, add to the retained earnings. But if you make losses, keep it separately as accumulated losses, which will now be on the asset side of the balance sheet, because it's a potential cash loss. Therefore, when you're calculating tier 1 capital, if the accounting norms in the country says accumulated losses to be kept on the asset side of the balance sheet, your tier 1 capital should take equity capital, retained earnings minus the accumulated carry forward losses or accumulated losses. I hope that's clear. So if you say, can we calculate tier 1 capital as combination of paid up capital and retained earnings? The answer is yes, provided if there was a loss in the operations of the bank and that loss is already subtracted from the retained earnings, your answer is correct. But if it is not and it is held as accumulated losses or carry forward losses, then you have to subtract that figure to arrive at the correct tier 1 capital. Then here's another question. When banks lend money, they set up provisions for credit losses. That's correct. That's provision for bad loans. We saw that just a couple of minutes ago in that spreadsheet. Let me show you that line. This one. Provision for bad loans. This is the line, right? 150 in the case of this bank. Now, when banks lend money, they set up provisions for credit losses. That means the probability that somebody may not repay. So this is a proactive measure. When these losses actually occur, that means there is a default by the borrower. They charge off loans against allowances for loan losses. Yes. So if a loan loss actually crystallizes, that means the guy is not going to pay back. You've made a provision, you take the money out of that provision and reduce the outstanding loan. That's the idea. Now, if for any reason they succeed in recovering the arrears, the question is, this year the guy hasn't paid. So as per the mandate of the central bank or the monetary authority, I have to write off that loan from the provisions that I have made. And the question is, if the following year we recover those amounts, that means what we have written off, we are still going after the borrower, and finally he pays. When he pays, how do we account for it? That is this question. What the person who's raised the question, Gong Saga, I hope I got the name right, he says, if for any reason they succeed in recovering the loans that have been written off, what he calls arrears, they add back to the amount to the gross loans and create a negative entry. That means add it back to provisions, whatever you have recovered, and increase the loan. It's almost like reinstating the loan on the asset side and reinstating the provisions that we had utilized on the liability side. How can the financial analyst assess the total stock of loans? So he said, if this is going to be reversed, this is a case of reversing the entry. When the guy doesn't pay, you reduce your provisions and reduce the loan because you have written it off. But when the guys pay back a year later, you increase the loan and you increase the provisions as well. Now, in most countries around the world, in the accounting, this is not permitted. If you do recover, it just goes as other income. You don't go back and repair what you've already done. Now what this will do is, if you take it as other income, it falls through, increases the profit for the year, and therefore it adds into the retained earnings. Last year you reduced provisions, tier 2. This year you have recovered the loan, it has come back to retained earnings, and therefore it now becomes tier 1, because remember, retained earnings is tier 1 capital. There could be the odd situation where what you have said might be true, but that is not the general accounting practice for loans. Precisely for the point that you have mentioned, how can an analyst or anyone assess the total stock of loans already charged off? You just lose track of it. Whereas if you do a clean accounting whereby if the loan has to be written off, it's reduced from the asset side of the balance sheet, provisions are reduced proportionately. And when it is recovered, don't fiddle with provisions and loans. You just take it as profits, other income during the year, so that it adds back to the retained earnings. I'll try and, you've said I would appreciate readings related to bank accounting. I'll certainly refer you to some material that you can go through. It would be best for you to visit the website in your country of both your central bank and the accounting body in your country, the chartered accountant or the public accounting body, because all of these accounting rules have to be agreed and synchronized between the banking regulator, that means the monetary authority of the country or the central bank of the country, and the accounting body of your country. So there must be something available on the websites of either of these entities. That will be the best place for you to go and have a look. There are variations in the accounting standards, although increasingly countries have adopted the International Financial Reporting Standards, and therefore it would be fairly consistent. So whatever I will send you would probably be IFRS data that may not be valid in every country. There could be variations to that. Okay, with that caveat, I'll send you some material. Okay, Basel II and Basel III. For a start, I want to say this. Shweta has sent in 4 or 5 questions, and I take them one by one. All of them are very interesting questions, so we will handle them one by one right now. I want to understand the changes made from Basel II to Basel III. Now, what we have seen so far is only Basel I. You know, in this course, you looked at Basel I. We haven't looked at Basel II and Basel III. We're going to do that in course number 5, special topics in banking and financial markets. Basel II is box standard, it's implemented universally. Basel II came into being in around 2004, and Basel III came into being more recently. In fact, Basel III is still not implemented in most countries. Central banks and certainly a lot of large banks are contesting that, because you can't avoid financial crisis by punishing the regulated banks to say you keep more capital and you keep more capital and you keep more capital. That's what Basel III is. So there's a lot of debate that's going on, which is why I have deferred the discussion on Basel II and Basel III to course number 5. Remember, we have a sweet compendium of 5 courses. This is the first one. This is in course number 5. So I would urge you to hang on till we hit course 5, which should happen around Christmas time. 28th of December, I think, is when course number 5 will be launched. I've dealt with this subject in great detail, Basel II and Basel III. The second half of the question prompts me to think that the person who has posted the question is from India. Is the rule same for public sector, private sector and foreign sector banks? Can we have a comparative analysis of the Basel norms in these 3 categories of banks in India? Absolutely. You know, the Reserve Bank of India doesn't make any distinction when it comes to capital adequacy norms about the pedigree of that bank. Is it a public sector bank? Is it a private sector bank? Is it a foreign bank? The rules of the game are absolutely identical. So the way you calculate tier 1 capital, tier 2 capital, risk-weighted assets, no variations whatsoever. The only difference is foreign banks which are not listed in that country. An example would be Citibank operating in India. Citibank is not a public limited company in India. It is a overseas operations of Citibank United States. So they don't have the equivalent of equity capital. Equity capital is replaced by the capital that Citi United States brought in when they set up Citibank in India. That's their equity capital. Retained earnings also. Citibank India, from the profits that it makes, it can repatriate a part of that profits back to its parent in New York. Or at the parent's discretion, they could decide, no, this money should be retained in India, in Citibank India's balance sheet to grow the business. That's the same as retained earnings. So it's exactly like Citibank India makes a profit, a part of it could be paid as dividends to Citibank head office in New York, a part of it could be plowed back as retained earnings, which is what would happen even in the case of public sector banks. Whatever dividend they pay doesn't go into retained earnings, right? It works exactly the same way. The only difference is the dividends don't go to the shareholders, the dividend goes to the parent company in New York, who has actually contributed to the tier 1 capital of Citibank in India. That's the only difference. Otherwise, computation of capital adequacy ratio is identical for public sector banks, private sector banks and foreign banks operating in any country. The regulator will not treat all of them with the same set of gloves. I request you to discuss if the concept of CRR and SLR are still relevant in the context of Basel norms being made to be strictly complied with to satisfy capital adequacy norms. Now, if you have understood everything that I have said so far, there is an embedded anomaly in that question. Cash reserve and statutory liquidity reserve are meant to manage liquidity. capital adequacy is meant to manage solvency. So one does not replace the other. They are mutually exclusive. All right? So that's the first point. The second point, very interesting, and we will see this when we look at Basel III. You know, several countries, several central banks did not insist on a statutory liquidity ratio. They didn't have it. For example, the United States didn't have it for a long time. Now, what Basel III did, which is an outcome after the 2008 crisis, because ultimately the 2008 crisis was triggered by a solvency problem in the system, but it manifested itself as a liquidity problem. And the belief was, if there was adequate liquidity, that means there was adequate cash with the banks, we could have bought some time and we could have resolved the solvency issue. Now, in the absence of cash, that means no equivalent of SLR, where they could go and sell government securities, turn it into cash and use it to meet their liquidity requirements, they didn't have it. So what Basel III came out with is a new ratio called liquidity coverage ratio. And while SLR is not relevant in most countries, they don't use it, LCR has to be implemented in every country because it's part of the Basel III norms. And we will discuss that later when we look at Basel III, as I said in course number 5. So LCR, liquidity coverage ratio, again talks about liquidity. In India, for example, we have a statutory liquidity ratio which is 20% of NDTL. LCR is not so punishing, but it still is a huge percentage. And it came into being after the 2008 crisis. In fact, came into being much later, almost 2 or 3 years later. And as I said, we will see that when we look at Basel III in one of the later courses. Next question again from Shweta. How Basel norms impact the performance of banks? I want to know what difference Basel norms has made on the performance of the bank. Is there any relationship between implementation of the Basel norms and the economic growth of the country? Have Basel norms slowed down the economic growth world over? The answer to the last question is maybe yes, maybe no. Is there any relationship between implementation of the Basel norms and the economic growth of the country? Economic growth, one of the contributors to economic growth is the easy or the ready availability of money for investments, which could either be loans given by banks or bonds that can be issued in the market and there will be investors in the bond. So if you are running a company and you want to expand capacity and you need $200 million, you can actually go to a bank and borrow, say $100 million, and the remaining $100 million, you could issue bonds and there will be people who will buy those bonds. Now, how bonds are issued, traded, etc., we will do in course number 2, which is debt and money markets, which is going to start on the 28th of September, which is 2 days from now. That is course number 2. So if you are interested in how the debt market works, how bonds are issued, traded, how are bonds priced, we've discussed all of that in great detail in the next course, course number 2, starting 28th of September. Now, in the meantime, if there is no money available in the system, for example, if you look at India today, and for those of you from other countries, it may not be so familiar, but there is an issue in this country because the non-performing loans of the government-owned banks has gone up exponentially. Same was the case in China a few years ago. Huge non-performing loans, which means their capital has got eroded. When they are writing off all these loans, firstly they write off from provisions. If there's not enough provisions, they will write off from the equity capital and the retained earnings. That means they will shrink the net worth of the bank. Now that's dangerous because when the net worth shrinks, T1 shrinks, that means the capital adequacy has gotten worse, which means somebody has to bring in more capital. If the bank is already in bad shape, nobody is going to bring in capital, therefore the bank is unable to lend. I hope I've clarified that. When there's not enough capital because too many bad loans, capital eroded, they're not able to lend any further, because if they did, the denominator of the capital adequacy ratio, risk-weighted assets, will go up, but the numerator has come down, which means your capital adequacy ratio will be less than the minimum required 9%. So banks are unable to lend, which means it will stunt growth. That could happen. So your question is partially correct, but to extrapolate and say that that's the only reason is wrong, because the lack of growth could actually be triggered by lack of demand, too much inflation in the country, people don't want to take loans, no consumption demand, no demand side financing, therefore no supply side financing, no growth, which is what economists would call a very recessionary situation. That was not caused by banks or lack of bank lending and ability to raise debt. It is because of a lack of demand. That could also stunt economic growth. So I hope I have clarified the question. Lack of capital in the bank could stunt economic growth, but that's not the only reason. Macroeconomic circumstances being adverse could be the cause for lack of economic growth. Or simply put, demand for goods and services in the country has come down. That's it. That could stunt economic growth, because GDP will automatically come down, gross domestic product. Has Basel norms slowed down the economic growth world over? I think not. If you go back to 1990, the late 90s, when Basel norms were implemented in most countries around the world, there was this fear that banks had to keep more capital, therefore it's going to hurt growth. Now 20 years on, empirical analysis shows that it has not impacted economic growth. On the other hand, it has attempted to improve the stability of the financial system in every country. That's what it has done. So has it slowed down economic growth world over? The answer is an emphatic no. I hope I've answered that question to your satisfaction. If you still have any doubts, do raise your queries on the discussion board and we'll be happy to respond. And here's a question by Sukanya. What is the reason for the failure of financial institutions in 2007? Everywhere in the course we learnt about risk-weighted assets and regulations and adequacy ratios mandated by central banks to ensure that large financial institutions do not collapse and will not take the world down with it. So I'm curious to know how the 2007-8 financial crisis unfolded despite such careful measures by the government. What are the top 3 reasons for failures of the entire system? I have a different way to answer this question. Despite all the traffic regulations that we have, why do we have accidents and fatal accidents? Can you blame the policing system and the road regulations for that? You can't. There are some guys who decide to defy the regulations and the rules laid down by the police and the state, and they cause accidents. Jumping a traffic light. I mean, a young kid would tell you that when the traffic light is red, you should stop. How many guys actually jump the traffic light? And how often are they the cause of accidents? This is exactly what happens in the financial system. There are regulations, everybody is meant to follow those regulations, but there is always the overt attempt to beat the regulations. And if the regulatory norms are not very tight, that beating the regulation becomes easy. In the United States, which is the hub of this activity, there is this huge component which is called shadow banking. Now, shadow banking is one where these guys are engaging in financial intermediation. They are taking money from people who have it and they are investing it somewhere where they think they can make money. Borrow at 8%, invest at 12%, make a 4% spread. That's financial intermediation. But the difference is these guys invest in high risk assets. Now, a bank can never do that because if it invested in high risk assets, its risk weighted assets go up, therefore it needs to keep more capital. In shadow banking, the entities are not governed by capital adequacy. A hedge fund, a CDO, And these are things which we will see in course number 4, where I talk about this whole issue in much greater detail. They're not governed by any regulation. They don't know what is capital adequacy, so they just start taking humongous risks. Now let's get to specifically what happened in 2008. There is a full video, in fact 2 of them, in course number 4, where we will, I don't know, it's course 4 or course 5, I don't remember. We have discussed this in great detail. It's probably course number 5. Yeah, course number 4 was going to be foreign exchange markets. After I discuss Basel II and Basel III norms, we will discuss the what caused the American crisis in great detail. But since you have raised the question, there were guys out there who were unregulated entities, and they were just trading at very high levels of risk. They were investing in toxic assets, and eventually it devolved on the banking system. Because remember, if you're a hedge fund and you're trading in high risk paper, you still have to have a bank account with a regulated bank in that country. And if you're not able to pay your obligations on a particular day, you would go and ask that bank, give me an overdraft to help me repay my obligation today. Tomorrow money is coming. The bank lends it, but tomorrow never comes. It devolves on the bank. So these unregulated entities, the shadow banking entities, got bigger and bigger and bigger because the regulatory system ignored them. And who got the flack? The regulated system in the end. That is the genesis of the 2008 crisis. For a more detailed discussion on this, and you're going to love it if you're interested in this subject, look for course number 5, starting end of December. Right. Again, Shweta is back with another question. I want to know how the regulatory mechanism work after a company default in India and the world over. What's the real difference IBC made in Indian perspective? How we find whether a default is willful or not? What measures can be taken to recover its dues from such willful defaulters? Now, willful defaulters are created by banks. You know, I've been in banking for 18-20 years before I moved to academics. And I know willful defaulters, you can spot them from a mile. Willful defaulters are defaulters because somebody in the bank either ignored the rules of lending or was in connivance with that borrower. Willful defaulters don't come up on their own. Some loans do go bad because of downturn in the economy or whatever. Those are pardonable. But if there are willful defaulters, you must go after them. And usually there are acts of criminality, and they can be put behind bars. They should be, because they are criminal. Willful defaulters are criminals. They should be put behind bars. If you look at a lot of the episodes in the recent past, with specific reference to India, there are some loans that have gone bad, and some loans which are gone bad, they are classified as fraud. The fraud is a willful defaulter. And in fact, the next question, one of you has even given the names of some of those willful defaulters. We'll just come to that in a minute. Now, IBC, which is the bankruptcy code, insolvency and bankruptcy code, it's necessary in every country. And those countries that don't have it, particularly when you have a high growth, GDP growth 8%, loan book is growing like crazy, corporate bonds are being issued like there is no tomorrow. You need a legal system that can cope with situations where loans can go bad, bonds will default on their payment obligations. Now, how do you know whether somebody defaulting is because of genuine business reasons or he's a crook and he's defaulting? Now, that's what the IBC ensures. To explain this very simply, let me give you an example. In 2008, as part of that financial crisis, and I never get tired of giving this example because it illustrates some basic principles of insolvency and bankruptcy very lucidly. In 2008, when the crisis happened globally, there were other things that happened. Oil prices went to $120 a barrel. Now imagine you're running an airline company. In the preceding years, the economy was doing very well. Passenger traffic was going through the roof, so you decided to expand. So you took huge loans and you bought aircrafts to cope with the passenger traffic, growing passenger traffic. Suddenly, 2008 comes and all companies issue advisory to their employees. Avoid traveling if you can. Do your business over Skype. Families stopped going on holidays. Airline traffic plummeted. Which means what? For the airline company, revenues plummeted. Add insult to injury, add fuel to the fire. Petrol prices, crude oil prices went up to $120 a barrel, which means aviation fuel prices went up, which means what? Costs went up. So if you're running an airline, you've got a declining revenue curve, it's a huge fixed cost business, and your operating costs are going up because aviation fuel prices have gone up. You're stuck. Your profits have automatically diminished. Your earnings has come down. Oftentimes what happens, because they've taken a huge amount of loan to buy those aircrafts, the interest burden is very high. Now, when revenues fall, costs go up, the operating profit is not even adequate to meet the interest obligations on the loan they have taken. Now, that's when a company becomes bankrupt. It can quickly become insolvent if the lenders don't take a gracious view of this and say, this fault is not the fault of the company, it is the fault of the macroeconomic situation globally, but they will not, because he's not getting his money back. What will he do? He will go and impound the airplanes, he will take possession of the assets that are charged to him and kill the airline and make him insolvent. Now, this was a case where the insolvency was not created by him. The insolvency was created by the downturn in the macroeconomic situation globally. If you have a bankruptcy law, and we didn't have one in India at that time, in 2008, what basically happened was, and I'll take a name, Kingfisher Airlines, which is in the eye of a storm now in India. The guy couldn't repay his interest obligations. Bankers pounded him, and they tried to take all the assets. Now his ego hurt, and he started playing games with them, and the games are still going on, as you know. Cut to the United States. They had exactly the same problem. Passenger revenue came down, costs went up, earnings before interest and tax went. When it went down, they were not able to repay the interest. What did the American Airlines do? 4 of them filed for bankruptcy. That means they went to the bankruptcy court, what we call in India today as the National Company Law Tribunal, NCLT. They went to the bankruptcy court and they said, look, no fault of ours, please give us bankruptcy protection under Section 11 of the Bankruptcy Code of the United States. Give us protection because we didn't create the problem. Revenues fell for no fault of ours. Costs increased for no fault of ours. We are not able to repay the loan. Now, please don't strangulate us to death. The bankruptcy code gives them protection. So, the lenders can't come and take possession of the aircrafts and the other assets of the company because there is a bankruptcy protection. Now, the bankruptcy code follows through and makes sure these companies take enough actions to come out of the bankruptcy protection. They give them 18 months to 2 years. The company can repair itself and it should come out of bankruptcy and be able to make enough money to start repaying its loans at least. If it doesn't happen in 18 months to 2 years, then the bankruptcy court would tell the airline, shut shop, you're insolvent, sell off the airplanes and have an orderly shutdown, or get acquired by another airline. In the US, 4 airlines filed for bankruptcy: American Airlines, United Airlines, Continental Airlines, US Airways. At the end of 18 months, 2 of them came out of bankruptcy. United Airlines, American Airlines. Continental, US Airways could not come out of bankruptcy. What happened? They got acquired. US Airways was acquired by American Airlines. Continental was acquired by United Airlines. All 4 airlines survived. And today they're doing well. Cut to a situation where we didn't have the bankruptcy protection, it got very messy. And the promoters of that airline feel peeved that for no fault of theirs, things happened and now everybody is going after them. In fact, that episode accelerated the legislation of the Insolvency and Bankruptcy Code. Actually, I keep telling all my colleagues, and I've said this in several conferences, It should not be insolvency and bankruptcy code. It should be bankruptcy and insolvency code. Because the first thing that should happen is the company files for bankruptcy. The court decides whether it will come out of the bankruptcy or it will become insolvent. They take the decision. Unfortunately, in India, after the IBC was framed, and this would not be very relevant to those who are attending this webinar from outside of India, but it's a very useful lesson. Every case being handled by the bankruptcy court, which is the NCLT, is insolvency petitions. It is not bankruptcy petitions. There are at least a few hundred companies that want to file a bankruptcy petition, but the NCLT does not have the bandwidth to look at them. So we haven't solved the problem. So these are operational issues. You need more bankruptcy court. Virtually in every city you need a bankruptcy court, which is different from the High Court and the Supreme Court and the rest of the legal system. Bankruptcy review and insolvency review is a very specialized business. All economies that are large and are considered developed economies will have a bankruptcy court and an insolvency court. We didn't do it. We should have done it 10 years ago, but better late than never. So we're doing it now. So I see that in the next 5 years, this whole bankruptcy code and insolvency code will strengthen, and we'll have more companies surviving and coming out of bankruptcy. In fact, our non-performing assets problem would never have been so serious if we had a bankruptcy code back in 2009 or 2008. The first version of the bankruptcy code, by the way, I had reviewed the draft of it because it was sent to us by the then Parliament Secretariat. We gave our comments. The democratic system functions so inefficiently that we actually tried to lock the stable, as they say, after the horse has bolted. You had these huge non-performing loans, and then you expedite and say, let's bring in the bankruptcy court. Why did you not do it in 2009? So we are suffering for it. But these are wisdom in hindsight. Hopefully we are learning from all of these mistakes and we will hasten things up. I hope that is a long answer to a very interesting question that you have raised. Right. The next one again is a fraud. Again, for non-India participants, this may not make much sense. But just to put it in perspective, there was this gentleman by name Mr. Nirav Modi. He runs a jewelry chain stores. It's global. He's got branches all over the world. This guy was getting too rich too quickly. He was doing this on the back of frauds that he committed on the banks. He's not a willful defaulter, he's a fraudster. Please understand the difference between the two. A willful defaulter takes a loan from the bank and then fails to repay. A fraudster is one who misuses the system to get money. A willful defaulter used the channels in the bank, credit proposal, etc., etc. Maybe he told a couple of lies to get the loan and then he didn't repay. That's a willful defaulter. A fraudster is one who knows what he's doing and he's in connivance with the bank staff. All right? Now, how did it work? He didn't issue letter of credit. That's not an LC. It is a letter of, I forget what the name was. Let's call it a letter of comfort, which is not the same as a letter of credit. A letter of credit is legally binding. A letter of comfort is, as the name suggests, a letter of comfort. He was using the banking system very smartly. What he used to do was he probably bribed 2 or 3 guys in the bank, and their names are known because they were the first ones to be arrested. In banks, you have the centralized computer system. All branches are connected to that. So when any transaction that you do, the debits and credits are created in that system. And any communication that has to go out of the bank to another bank elsewhere in the world, the transaction is routed through the core banking system. It is recorded in the bank's accounting system, and only then the message that has to go out will go out. Here, and the way it works is, this was through this terminal called a SWIFT terminal. SWIFT is an expansion for Society for Worldwide Interbank Financial Telecommunication. All banks are connected to this. So if I, working for, let us say, State Bank of India in India, want to send a message to say, please receive this money on my behalf in my operations in Tokyo, I would send it to Bank of Tokyo in Tokyo through this SWIFT system. And when they receive the money, they will inform me saying we have received the money. If I want to issue a letter of credit, I will process the letter of credit through my computer system, and this message will go out on the SWIFT to the other bank who is the beneficiary of that letter of credit. Now, the only way, therefore, you can route the transaction is through the computer system, through the SWIFT system to the outside world. Now, the fraud in this particular case was nobody should have access to that SWIFT system. It's a physical piece of hardware and software. The only way for transactions to get in is from the bank's core banking system. Here, the fraud was there were a few employees who could process the transaction directly into the SWIFT machine, and it would go out. No record in the accounting system. I hope you understand the dilemma. Nobody knew this was happening. So there were two flunkies sitting somewhere in one of the branches in Delhi who were happily pushing these messages through, and it was going out. The beneficiary bank were branches of Indian banks in Hong Kong. So there were United Commercial Bank, UCO Bank. They would receive this letter of comfort from Punjab National Bank, which is the originating bank. On the strength of that, they have given a loan. What is this letter of comfort? In case Nirav Modi fails to repay you, we will bear the burden of paying you. It's like a letter of guarantee, right? But it's not recorded in the system here in Punjab National Bank. No contingent liability created. No off-balance sheet details. Nothing at all. It's not shown in the books of Punjab National Bank. Now, when Nirav Modi started to default on those loans, UCO Bank made a claim on Punjab National Bank saying, look, here's the letter of comfort. Your man is not paying. Please pay up. When that happened, they said, what the hell, who issued this letter of comfort? Nobody knew. So it's a process failure. It's a process failure. I figured this out on day one as to what had gone wrong. But until I explained to you, and I hope you understood how I explained it, this is what we call an operational risk. Did we do operational risk in the first course?
Operational risk in the first course. Yes, sir.
We did. So go back and look at your lessons on operational risk. This is an operational risk. Somebody had direct access into the SWIFT system without him going through the centralized computer system. That was the crux of the problem. How to make employees accountable in such cases? Look, there will always be thieves in any system. The bank's operational processes should make sure that nobody has a direct access to the SWIFT system in this case. If that wasn't possible, this fraud would not have happened. Can you recover it? Well, it's like chasing your own tail. It will go on all kinds of loops. Recovery is not going to be very easy in this case. And now they're going after the crook himself and trying to possess his assets and so on and so forth. It gets very messy. Who caused the problem? The bank itself, because it's an operations failure. It's a technology failure. And most operational risks are because of technology. What is the gap here? Direct access to the SWIFT machine. That was the crux of the problem. Okay? I hope I've answered that question. So that was actually the last question in the series. Did we have any more questions posted by anyone?
So just one participant, Lokesh, is asking, what's your opinion about Naeem Siddiqui's book for credit scoring and Bart Bessin's book for credit risk analysis?
Sorry, say that again. The name of the books.
Yeah, the credit scoring by Naeem Siddiqui.
Okay.
And credit risk analytics by Bart Bessin.
Okay. I'm not familiar with the contents of either of these books. I presume those are the authors' names. I'll have a look at it. And quite frankly, it will not be ethically correct for me to be able to comment on those books, in a video webinar like this. So I will go through that. If you will send me an email, I'll go through those books and revert back to you with my thoughts on that book. Okay? That's it?
That's it.
Okay, so we have overshot by almost 15 minutes. It is almost a monologue from my side trying to answer all your questions. What we will do is to upload this webinar as part of the course. So you will have one more section in the course on edX, which will take you to this webinar so you can play it again. It's also beneficial to those who could not participate today, and this should help you in broadening your understanding of banking and financial intermediation. As I said before, the course closes day after tomorrow, and then you have a week to complete the exam, which is the graded exam, which will help you get the verified certificate, provided you have gone through the process of paying whatever the amount, I don't know what it is, and which then makes you eligible to register for the second course. You can register for the second course even before you complete this process. But I would strongly urge those of you who have done this course to do all the 5 courses in this series, because as you would have figured in this webinar, they're all interconnected. And if you want to have a holistic understanding of banking and financial markets, you need to go through all of these 5 courses. The second course deals with debt market and money market. That goes on for 4 weeks. And then we move to equity markets, and after that foreign exchange markets, and finally special topics in banking and financial markets. So if you go through all of those 5 courses, you could be a big daddy in terms of risk management in whichever organization you're working. Okay, with that I'll close. Thank you very much for staying on through the webinar, and wish you all the best for the forthcoming exam, and we'll see you for the next course. Good night.